welcome everyone to CBIC for the Founders Session 5. So today we'll sort of be talking a little bit about exits, and we have Scott Zickefoose of Keiter, we have Clare Lewis of McGuireWoods, and we have Tracey Gillespie of Wells Fargo. So hopefully you guys were able to sort of listen to the pre-recorded content and get a sense of what's going on. And so we'll let each of our experts speak a little bit about their area of expertise, and then we'll really open it up to questions. So feel free to ask questions that are more general or some that are even more specific to your particular set of circumstances. This is really open office hours and a time for you all to dive in. So with that, I will kick it over to Justin Ritter, CBIC's Program and Events Manager.
Hey everyone, just a quick favor to ask, if y'all could just, if you're not talking, mute your microphones just in case you get secondary noise that you'll pop up on the screen inadvertently. So if you could do that for us, that'd be most appreciated. So again, India gave brief intros, but just to maybe formalize it a bit more, today we have Clare Lewis, partner of McGuireWoods, with us today to talk about, during this open office hours session, about any legal matters related to startup exits. We have Scott Zickefoose, partner at Keiter CPAs in Richmond, to talk about any tax exit related questions that you have. We have Tracey Gillespie, a business transition strategist for Wells Fargo, with us today. And what we would like to do is start with Tracey, since if you've been following the pre-recorded content, we haven't heard from Tracey before. And Tracey's going to give us a perspective on the life of an exiting founder from a financial planning perspective. So I think it'll be a bit distinctive from Scott and Steve's pre-recorded session, but fairly related. So with that, Tracey, if you could please maybe give a brief introduction and tell us more about an exit from the perspective of a founder, pre and post.
Great. Thank you, Justin, and welcome everyone. I'm thrilled to be joining you today via Zoom. I am a business transition strategist, and what the heck does that mean? That's an unusual title. Well, my background actually is in corporate and investment banking. And so many, many years ago, I did a lot of M&A deals. And one of the things that I found in working with privately held businesses and their owners was that the owners were often saying, wait a minute, I'm not quite ready to exit. I don't have things put in place. I'm not sure I really want to go through with this. I'm not sure I've looked at all the alternatives. I think I should have been doing some planning a long time ago, and I never did. And so about 20 years ago, I actually went into the business of helping owners on planning for their transition of ownership, hopefully many years in advance. And somebody recently asked me, well, how many businesses have you worked with over these 20 years? And so I sat down and started counting it up. And I stopped at 1,000. I've worked with over 1,000 businesses over these 20 years and helping them think through what is next. How should I plan my exit? And so I'm hoping to share with you in the next 15, 20 minutes some of the things that I've counseled other business owners on that you can take some notes on if you like, or if you have questions, we'll answer them at the end, and I'm always available offline as well. So let me start with what is top of mind for business owners right now, because we're in a period of tremendous uncertainty, tremendous change, as all of you know, and we've got shifting landscapes. We've got shifting economy, shifting political landscapes. Because of COVID, I've seen some businesses just go gangbusters, and I've seen others that have been very, very challenged. So we're seeing business success, and then actually right now we're seeing businesses boomerang, coming back to almost pre-COVID levels. So we're seeing a lot out there, and with all this uncertainty, people are saying, well, how do I plan in the context of this? And because so much is so uncertain, and I tell clients that the key to planning your exit is to do it so far in advance and at such a, what I would call fundamental level, that it can be adaptable to various economic situations and movements in the market. And I also encourage business owners to think about two words. One is clarity, and the other is confidence. I want to have clarity around what I want out of my exit, and I want to have confidence to move forward. So whatever kind of due diligence or planning you need to do to develop the confidence that you're making this decision correctly is the right amount of due diligence for you. So some people are more oriented toward that than others, but confidence is important in terms of moving forward. Because quite frankly, in the exit business, there aren't any do-overs, right? And mistakes can be very costly. So you don't want to make a mistake and try and do a do-over and it's too late. So let me share with you a story about some business owners that I'm working with right now. There's 3 owners. They're in their mid-40s. They started this business 10 years ago. They had worked for somebody else, and they all left at the same time and started this new enterprise. And they've grown it to over 300 million in revenue, which in 10 years is a very significant feat. And they made a slight mistake recently. And that precipitated them calling us. And that slight mistake was they said, okay, well, we're 3 business owners. Other people have helped us build this business. We want to bring them into ownership. And they built a incentive comp plan for these other key employees that was not the right ownership plan for the circumstances. And I'm sure Claire and Scott have seen some, and maybe even Justin have seen some of these errors in the past, but they didn't do their due diligence up front and therefore came to us and said, how do we create this differently? And oh, by the way, we need a path to exit. We think we want to exit in about 10 years. And we want to understand what are the steps to that exit. So we basically help them, first of all, and this is the first thing we do with every group of business owners, is to drill down into their objectives. What is it they really want to achieve in their exit? And we encourage people to look at their objectives in really 3 categories. One is, what do they want for the business? So these guys built a great business together. They cared about their employees. They built a great culture. And to them, it was very important to have those things sustained in their exit. So that was one aspect. How was the business going to survive? Secondly is, how were they going to benefit? They're investors in their business, right? They put money in when they started it. They've retained a lot of that money inside the company to have foster its growth. So as an investor, they have objectives. What do they want to get out of it when they sell the business? How much money can they take out between now and when they exit 10 years from now? So it's just like having any other investment. You get current income and you get income when you sell the business. So that's the second bucket. And then the third is what I would call the lifestyle aspect of being a business owner. Early on, when you start a business, you think, oh, I have no lifestyle because I have no life. I'm just working, and there's nothing else but the business. But over time, you get the opportunity to bring things into the mix that enhance your life and actually become very important in your post-ownership life. Things like philanthropic endeavors or community involvement or mentoring. These three business owners actually were really into developing their people and leadership development and coaching within their company. And so that's something that they want to continue post-exit. So understanding your objectives in those three areas is very important. Step number 2, and what we're doing for these folks, is help them understand what their business is worth. A lot of people think about what is their business worth based on information they get from their friends that aren't qualified to give them a range of value analysis. And Scott, I see you smiling there. So you've seen this. People will say, oh, well, you know, my company went for 12 times EBITDA, so surely yours should go for 15 times EBITDA. Not really understanding what is the difference between 12 and 15, and why would anybody command a multiple like that. Having an anecdotal understanding of the value of your business when you're planning your exit, and particularly when you're planning it over a period of time, it's not a really good data point. You need to have what we call a range of value analysis, where we look at not only what is your business worth today, but for those that have a long runway, like our three business owners, how can they build value over time? How can they use the next 10 years to create value that's going to accrue to them while they own it, as well as the terminal value? And so understanding what your business is worth today and how you can make it more valuable into the future is a critical component of business exit planning. People think business exit planning is about a date certain and tax events and maybe some contingency planning. But in my opinion, it's about how much runway do you have and how much value can you create during that time frame. Because that's where wealth is created, right? And personal financial security. So that's step number 2. The step number 3 that we're working with these business owners is look at your options for exit. 51% of business owners end up selling their business to a third party. That's either a strategic buyer or a financial buyer being a private equity group. Not all businesses are well positioned for those exits for a variety of reasons. Private equity groups, for example, typically use leverage or debt on the company to buy the company. So if your company is not easily leverageable or it's already leveraged, it's hard to execute on that. Some people, the businesses, there aren't strategic buyers in the market at that point in time. So the other 49% are looking at exits like selling to a management team. So in other words, a management buyout. Another option is an ESOP, selling to all of your employees. A third is, and people are doing this more and more often, selling it or gifting it to your children or your heirs. This is particularly popular with real estate enterprises. So think about what your options are. We're helping these 3 business owners evaluate that right now and help them understand, you know, based on what they want for their employees, is selling to a private equity group going to be a viable option? How would that compare to selling to a strategic buyer? So part of the pre-sale planning that Justin wanted me to help or talk through with you today is really around evaluating your options, because you can't plan until you evaluate what are the different paths. Then you can pick a path and move forward to it. So for some business owners, they say, okay, I want to sell to a strategic buyer and I want to do it 5-6 years from now. Well, in that case, you can build a path of value creation and build a path of making your business more attractive to that potential strategic buyer. And there are very specific things that you can do that are very specific to your company very often that will result in success. So we have a client, two brothers that own a business together that we worked with 4 years ago. And we understood their objectives. Even though they're brothers, they had very different objectives. They had different timelines, different financial needs. We helped them understand the value of the business and how their different exit options would play out for them individually and for their company. They chose to pursue an exit to a strategic buyer, but they also realized that they didn't have, they had a little more in them. They weren't ready to exit yet, and that they could build value. So we helped them map a path to building value, and we just re-engaged with them about 3-4 weeks ago, and we're planning the exit or the sale of the business in 2021. So we are in the process of engaging investment bankers to begin to take them to market and do the due diligence that it sounds like you guys have already talked about pre-exit. So I would say that's a good example of somebody that did all their homework and decided, I'm going to wait 3 years, build some more value, and then exit. So another element of pre-sale planning is on the personal side. And we talk to business owners all the time about making sure that they understand the economics of the decision they're going to make. So if they're going to keep the business for another 10 years and then sell it, well, how much wealth can they accumulate between now and that date of exit? And how much terminal value do they need to get out of the company to meet their retirement goals or their financial goals? So it's very important to sit down with a financial advisor and begin to project what kind of lifestyle you want post-exit and what it's going to basically cost you. And what are the goodies you want? So many of the business owners that we talk to were like, you know, I built this great business. I want to exit and have a really nice beach house. So you model that into the numbers. Or you want to give money away to charity. We model that into numbers. So understanding what it is you want to achieve on a financial basis is a really important element. Another thing that we are very focused on right now, and Scott can speak to this in the Q&A, is the tax implications, both income tax and estate tax. There are, in the Biden proposal, a number of shifts in both of those areas with regard to tax implications for exiting owners, and also what you can do about it now should there be a shift in those policies vis-a-vis gifting of company shares to take them out of your estate so that the appreciation and that value occurs outside of your individual estate. A good example of this, I don't know if any of you on the phone are in this situation, but we see a lot of companies that have intellectual property. For example, a software company or somebody that's got a unique piece of intellectual property, and they may set that up as a separate entity and gift shares of that entity to their heirs as a way of pushing value outside of their estate. So there's a lot of innovative things that you can do with regard to tax. And one more thing about pre-sale planning is most people love to plan for plan A. This is what I'm going to do. It's going to look like this, and here are all the dominoes, right? Unfortunately, life doesn't always look like plan A. So you've got to make sure you have a plan B, which is your contingency plan. What that looks like is how are you going to deal with or manage around life's interruptions, whether it's a timing related thing, i.e. you can't exit 10 years from now because of health issues and you've got to exit 3 years from now. That's part of a contingency plan. Or 10 years from now, the market's fallen away and you're going to have to be in the business for another 3 to 5 years or another economic cycle. We're seeing that a lot right now. Well, how are you going to deal with that? Are you going to exit the business as an operator, stay in as an owner, and get somebody else in there to replace you as the senior executive? So there's a lot to contingency planning that is around the succession and management of your business, but then also the economics with regard to unplanned circumstances. So we work with owners to make sure they understand what that plan B is. So let's assume that you get to exit either through A, preferably A, not B, and you've done all your financial planning, you've done your succession planning, you've picked the right exit partner or the next best owner of your business. And now you're standing on the other side of this great life's achievement. And what do you do post-exit? And I would say that waiting until the day after to ask that question is about a year too late. You really need to think about what am I going to do post-exit about a year before you actually walk out the door. And it really comes down to how you're going to use 3 things: your time, your talent, and your treasure. I mean, it all boils down to those resources, and however you want to do it. I've seen people exit their business and live through a 2-year non-compete and restart another business in a similar vein. I've seen people turn around and start a family foundation and redirect all their energy toward a lifelong ambition for doing good that they couldn't address while they owned the business. So having the flexibility of time and the underpinning of a tremendous amount of talent that you've acquired over your lifetime, and then, of course, the treasure to be able to do it positions you well for picking just about any path to go forward. So with that, I will turn it back over to Justin because I think I've covered the life cycle there.
Very cool. Tracey, thank you for that. With that, I just want to touch now a little bit on some legal that perhaps Steve didn't touch on in the pre-recorded session, and I'll turn that over to Claire. Claire, when we're talking about startup company exits, do you have like just a general rule of thumb of some do's and don'ts that you think that early founders or aspiring founders should keep in mind now?
I do. Thanks, Justin. So, you know, when I think about the phases of a deal, I put it into 4 buckets. So we'll start with the first phase, but then we'll sort of move through. The first phase is the pre-signing period. And the importance there is the NDA that you're going to sign. If it's a sell-side deal, you're selling your company. It's really important. If you're sharing confidential information, make sure that the confidentiality section, the confidential information definition is broad enough to capture everything you're sharing. And many times buyers will try and winnow that back. So that's can be a gotcha sometimes. So make sure that the drafting and the NDA is not just boilerplate, but actually covers everything you're sharing. And one note, you have legal agreements, but then you also have folks who don't abide by legal agreements, and you might have a breach of contract claim. But you just have to be careful as a seller when you're opening the kimono. Some things just can't be protected anymore. They might be legally protected, but people could still steal your secrets, and then you have to hire a litigator. go after them. So source code for SaaS and software companies is a big one. You usually wait until you feel really comfortable you're going to move forward with that buyer before you share that source code. The LOI, or the term sheet, is also really important, as Steve mentioned, and there'll be mostly non-binding terms in the term sheet or the LOI, a few binding terms. Of course, the buyer is going to want to make sure they've locked you up. They're going to want a no-shop provision. So you want to be careful what you signed up for there in case the deal doesn't go through with that buyer. And so you have options to do other different exits with different buyers if you need to. The reverse due diligence you do on yourself before you enter in negotiations with a buyer is really important, and you can find them online. I'm happy to send out sample reverse due diligence checklists. It is a huge bucket list of everything that a buyer might ask you, and like Tracey mentioned, they're going to look at your equity, your cap table, and whether you papered it correctly. Many times sellers promise equity to folks and then they actually don't get around to papering it, but those promises are still hanging out there. And you're going to have to sign up to reps and warranties in a definitive agreement, which is what we get to in the second bucket, that says that the cap table as set forth on a disclosure schedule is true and correct. And that's going to be a rep that's going to last for a long time. So you want to make sure that you've got your cap table tied up. And you've thought through the equity compensation in terms of structure that's appropriate for your company, incentivizing your employees properly, and tax considerations, which Scott, I'm sure, will speak to later. So when you're doing that, you also want to keep in mind the transaction structure. And Scott and Steve talked about that a little bit on their pre-recorded section, but you want to think about, is this going to be an asset deal? Is it going to be an equity deal? You can't necessarily predict what it's going to be, so you want to be open to different structures and their tax implications, of course, with those structures. Mergers, of course, are also big, particularly with SaaS companies and software companies, reverse triangular mergers. And when you're thinking about that structure and your due diligence, you want to think about your contracts. If you're doing an asset deal and you have to get consent from all of your customers and all of your vendors to assign that contract to a buyer, that's going to be a bit of a headache. So where you have the ability to, because the general rule is in most states is you can freely assign contracts, but if you have a prohibition on assignment in your contracts, then you're going to have to go get those consents. And I can't tell you how many times, and Scott, I'm sure you've had in your deals, where a landlord is going to hold up a deal because you have to go chase their consent and they're on a beach in Maui and they don't respond to email. And, you know, instead of getting your money that Tracey is going to help you with, you're dealing with finding some landlord who's, you know, gone off the radar. And the buyer won't, you know, wants that to be a condition of closing and won't waive that condition. So think about that as you are entering into your contracts. In the second bucket, so this is the definitive agreement that you're negotiating. You might have different governmental filings you're going to have to look at. CBIC has become a bigger issue, particularly with international buyers. And then you're going to have to make sure you get all of your shareholder and your board approvals there. The third bucket is actually closing, and sometimes you have a simultaneous closing, so you sign up the agreement and you close at the same time. Sometimes you have it delayed. So one of the cases you all have probably seen in the news is LVMH did a delayed sign and close with Tiffany's, and now LVMH is trying to get out of that deal because the economics have changed. That's very tough as a buyer to get out of that, and a material adverse effect is generally a definition that you're looking at. And Delaware generally says it has to be a precipitous drop of, I think it's over, 30% decrease in EBITDA before they even sort of look at it. So once you've signed up that agreement, there's a lot that can happen before you close. There's some challenges if you do a delayed sign and close, but there might be reasons you want to do that. You have to get a number of different consents from your customers, and you want to make sure you have a buyer who is going to hopefully proceed with the transaction. You want to sign them up, but you don't want to notify your customers you might have a delayed sign and close. So structure is important there. If you're doing a merger, you're going to have to file, you know, different corporate documents with the states. You want to get those teed up. And then the last bucket is post-closing. There are many things you will push to the, you know, to after the closing. As a buyer, there might be compliance issues. Data privacy is becoming really big. So compliance on the data privacy side many times will become a post-closing issue. So, if you're lucky, you can kind of push off some of the gaps in compliance that companies might have. You're also going to have, the announcements. You want to make sure that you don't violate any confidentiality provisions there in terms of announcements. And then, as is common in recessions and post-recessions, you have different purchase price adjustments. So working capital purchase price adjustments and earnouts. Earnouts are to bridge the gap in valuation if buyers and sellers can't agree on a straight price at closing. And the seller thinks, oh, I can achieve whatever EBITDA or gross profit or whatever metric it is. And you want to be sure that you feel comfortable with the drafting language. You have that purchase agreement as such. If you are a seller, you're going to be able to hit that metric. And if you can possibly get covenants so buyer doesn't cook the books or, move things around in a way that you aren't able to hit your metrics, you want to think about that. You get help from your banker and Justin to structure that. You do get that purchase price adjustment that you want to definitely earn. So Justin, those are generally the 4 buckets that I think of and the issues that kind of come up along the whole life cycle of a deal. I don't know if we have any other questions from the audience or if you have any other questions, but those are sort of high level points that I see come up again and again on my deals.
Yeah, well, I think that's really great stuff, and thank you for that. I want to ask one anecdotal question or just observatory question, but in the interim, if you want to ask questions in the chat box, if you could just ask it to everyone, from there we can try to field the questions appropriately. And I have a feeling, I'm really curious, Tracey, to see what you have, and I'm sure everyone has a good story, and I'm going to share one too. What's some of the coolest exit experiences that you've had? And I'll just share mine real quick. It was when I first started practicing law about a decade ago. There was a sale. The seller was a business owner of a multi-generational family-owned company. And the buyer was key employees that had been with the company for a long time. And at closing, somehow, and I don't know how, they got a gold watch from the first retired employee of that company and gave it back to the seller, who was, was like 70 years old and was retiring after the sale. And, it's quite a touching moment. I was just curious if y'all ever have had like a really cool exit closing experience that's worth sharing.
I've got one that is probably one of my favorites. It's a family that inherited a business from the founder. So gentleman founder, his wife and 3 daughters inherited the business. And he didn't do a good job of exit planning. So he kind of left everything just unattended. And this is a company that had a lot of intellectual property. It was global in nature. And it was very important to protect that intellectual property around the world, as well as set a path for future expansion of the intellectual property. The middle daughter, decided to take on the role of CEO. But because of the way the governance was set up and the ownership was set up, every time she wanted to do something as a CEO, she had to go ask her sisters and her mother for permission. And they were not active owners in the business at all. So they had no idea what she was talking about. And again, this is an intellectual property-based business, global in nature. So it wasn't like, they were making ballpoint pens. No, this is a very complex situation. When I met that business owner, she said, listen, either I fix this or I'm leaving. So she was at that crossroads and she had a very short fuse. And so we came in and helped them rearrange ownership to meet the needs of the mother and the 2 sisters. And after the business was recapitalized with regard to ownership, and my friend Ann, and our client, was in control, that business took off and grew at about a 10-fold pace over a number of years. And it's been exceptionally successful. The exit is not done yet. Actually, Anne decided to turn the reins over to her heirs, some people in the family, and they are continuing to create value. So this is a situation where value is being created incrementally, and then there's even more terminal value for the family. But the game plan is to sell eventually to a strategic, which they haven't done yet. But it's about enabling the success of the shareholders, whether it's the current group or the future group. And with really good planning, you can get that done.
Very cool. So we have a question from Noah. He says, in my business, I have a piece of IP I'm working to sell as the entire business. How much would this overlap with exiting as a process? Any thoughts there?
Can you read that again to me, please?
In my business, I have a piece of IP I'm working to sell as the entire business. How much would this overlap with exiting as a process? And I'm a little unclear as to what that means myself. Noah, do you want to elaborate?
Yeah, sure. So I actually have gotten all the way through the patent process, except for the final application bit. I have this patented piece of intellectual property at this point, and the only reasonable way to get it into existence that I can see right now is to sell or license it to, it sounds sort of like we were talking about with a strategic, somebody that's currently in the industry. And so that's what I'm working to do right now. Some of the stuff that you're talking about in terms of due diligence and making a sale of an entire business sounds similar, but I'm curious as professionals how, if you have any experience trying to sell just IP, or if this process in fact is wildly divergent, because I have no experience with either of those things.
Well, I'll go ahead and take a stab and then let others on the call today answer as well. My initial thought is don't sell what you can license. So retaining ownership, you only can sell that ownership once. So retaining ownership and coming up with a revenue model and a joint venture arrangement or partnership arrangement with others that have a need for that intellectual property and a distribution channel. So the company that I just spoke to a moment ago, they had all this intellectual property, but they were in a similar circumstance. They didn't have the resources to take it to the fullest next level. So what they did was they set up licensing agreements around the world with people that had a vested interest in utilizing that intellectual property and creating value for themselves and therefore the original owner. So I would encourage you to think about how can I set up licensing agreements with those that are around me that can leverage this. Eventually, those licensing agreements will become your exit strategy. Somebody over time is going to bubble up and be the next best owner of that intellectual property. And then you can move in that direction. And of course, you've got to coordinate that with your other licensing agreements. But that would be my 2 cents worth. Claire, Scott, others?
Sure, I agree. And it's tricky, Noah. This sort of sounds like it's almost a carve-out transaction, and there can be very good reasons to do a carve-out transaction like this, but you have to be super careful that you're not carving out the family jewels in a way that is just shooting yourself in the foot down the road, to the extent that a buyer wants that IP and maybe they want it exclusively. Maybe they don't even want anyone to license it. So can you get out of that license deal? Maybe it makes sense, maybe it doesn't. And no one has a crystal ball, but so you want to be really careful how the license is drafted. And IP is a very different area than contracts law. So to grant a license, you actually have to use specific present language that I grant a license. And so it's really important to have good IP counsel, which it sounds like you might have since you're going through the patent process, which is great. But it's almost two different worlds when you're doing a deal versus doing an IP license arrangement or the sale of the IP itself. You have to think down the road, what is the value of your company without that IP if you've sold it, or with that license, given whether it's exclusive or it's not a non-exclusive license.
So I really don't have any interests other than the eventual implementation of this particular intellectual property. If the problems that this system addresses are not fixed, the most likely outcome I see is a general societal collapse. And if this is actually implemented, if my solution to this problem is the solution that is done, then even if this were stolen from me, as long as I'm alive, I'll be fine. So there's literally nothing other than this that I care about.
Okay, got it. Does that do our responses at all answer your question or give you helpful food for thought, or do you have further questions on this?
The licensing versus sale, I mean, it's sort of interesting to think long term, and what Tracey was saying about post, that's something I haven't really thought about so far. But the major question is, I'm basically trying to find a way to go forward, and I'm curious whether or not engaging with an exit process, since that's also similar to sales, is likely to be productive or not.
And it's possible that Scott has some thoughts there. I mean, I go to valuation first. Can you get a higher valuation on either licensing the patent and getting future royalties, or selling the IP itself, rather than a process where you sell your entire company and the IP? Sometimes the whole is worth more than the sum of the parts, but not always.
Yeah, and Claire, to kind of elaborate on that, a couple of considerations. One, if you can proceed with a licensing agreement temporarily, I think it helps quantify the value proposition, which might help you later in a sale process. So you can understand what value you bring to someone, because you see how people are utilizing this IP and the kind of benefit that they're deriving from that utilization. So it kind of preserves optionality if you can, in the short term, license it, see how it's working, see what does well and what doesn't, and then entertain a sale after that. Also, not to let the tax tail wag the dog, but there is a little bit of a difference between the taxation of a royalty or licensing agreement and a outright sale of your IP. So in the short term, you're not going to get as favorable of tax rates on maybe a licensing arrangement, but it's probably, from my perspective, worth that kind of to see how the technology plays out, or whatever IP you have plays out.
I think that's right. And if you can get a non-exclusive license, that would be even better.
Because you might find, and again, we don't know the nuance or the technical specifics of your IP, but a lot of times people find that there's alternate uses to their IP that they haven't even considered yet. and you only see that by exploration and conversation. So to the extent that you can license it for a specific purpose that you know it's good for right now, out, and then, you know, who knows what else could happen. So, you know, you're preserving that long game by just licensing it rather than selling it.
So Noah, feel free to put any more questions in the chat, or let us know if that doesn't answer your question. Otherwise, we'll move to Wilson's question about no shops.
Yeah, thanks.
Okay, great. So Wilson had a question about what's a reasonable no shop, the length of a reasonable no shop provision. Generally see around 90 days. You know, if you can push as a sell side, if you can push for it to be shorter, that's great. Maybe you can get 60. But, you know, 3 months, I think generally covers a reasonable due diligence period to get the definitive agreement and get everything signed up. And it's common to have extensions to the LOI or the no shop as things progress. Diligence is taking a long time. Everything's taking longer in the pandemic. But yeah, the shorter period you can agree to, the better, obviously. I know you're thinking about that, and when to agree to that. So you want to sign up the NDA before you share any confidential information. And the LOI is a process. On the sell side, you know, I think Steve said in the pre-recorded session that, you know, the longer the better on the sell side, because it can be your last chance to negotiate things. And I think that's true, particularly if you can really negotiate the indemnity package that you're going to have to agree to. And that's the survival period for your reps and warranties, which reps and warranties are going to be fundamental and survive a longer time, what the basket looks like, the cap, all of those good provisions, what conditions are going to be required to close the deal. The better. So that can take a while to negotiate the LOI, and you want the buyer to also dual track, be doing their diligence. So they've actually got skin in the game. They're reviewing your contracts. You've put together a data room and you're providing them information. You know, if you're a software company, maybe not your source code, not really super confidential things. Maybe you've shared your financials, maybe you haven't. And so that process is happening simultaneously with the negotiation of the LOI. And so you're still at that point, you're not bound to a no shop, so you could pursue other buyers. And it's always best to have multiple buyers. Scott can speak to this more than I, but it makes it a little bit easier for you to have a stalking horse to, you know, make sure you've gotten good valuation. Because you might agree on a purchase price, but like I mentioned, there could be earnouts, there could be working capital adjustments, there could be things that directly or indirectly decrease that purchase price that you're actually going to receive in your bank account that Tracey's going to help you plan for. So it's always nice if one buyer has some sort of sticking point, like IPs is many times a big sticking point, whether, you know, there's some IP issue, you haven't gotten all of your employees to sign a covenants agreement, and then they've gone into a teak forest and you can't get them to sign a document, or whatever happens. Some buyers can have different sticking points that they really they dig in their heels on. And so it can be nice to have other ones that you can go back to the extent that things don't work out with your chosen suitor.
Yeah,
Does that
Claire,
answer your question, Wilson? Yeah, go ahead, Scott.
Yeah, I was just going to add, I think 90 days is the right time. And you really want to be mindful of kind of the sequence of diligence so that you can keep the process moving, but you can clear the hurdles of risk earlier in the process before exposing what you view as like the most critical aspects. So whether that's a customer list or your sales force, like linking sales productivity to specific salespeople's names, or whatever it is that's critical to your business that you don't want your competitor to know about, that might come later in the process of diligence, so that you've kind of erased as much risk and cleared as many hurdles before you get to that, whatever that big thing is.
Cool. Most appreciated. Thank you for that. We have a new question here from Claudia, and I think there's a lot of meat to this, so I'm just going to read it in full. Quote, I'm rather early on in a new venture that is garnering a lot of interest and development. In your experience, at what point do founders start looking for possible buyers? Do I create a product that could be purchased by my ideal buyer? And how is this actually done? Do I hopefully gain a lot of users/customers and hope to get the interest of a large consumer goods company with a lot of cash on their books, or are there consultants to help founders link up with these potential buyers? Thank you for your time/expertise, folks.
Justin, I'll take a stab at that.
All right.
So Claudia, thank you for your question. It's a very good one. And I will tell you, I'll tell you that strategic buyers, who you're really talking about here, buy two things. They buy a track record and they buy potential. So if you can demonstrate a track record, it brings validity and certainty to your potential. I've seen a lot of people that are very early on in the formation of their business and the formation of their product set and their value proposition, whatever the product or service might be. And they think about the potential and they spend a lot of time mapping that out. And they don't realize that potential buyers or investors are going to haircut that potential based on the track record. So you've got to have enough track record to be able to demonstrate that the potential you're forecasting is reasonable. What the enemy of investors is overpaying and not foreseeing all the risk. So they are, even though it looks like, oh, well, they're not risk averse, they're very risk adverse. So however you can create your track record to demonstrate there's less risk than what they will perceive is a really good investment in your time. The other question you asked is, should I develop a product, or at what point should I start thinking about who's going to buy my business? And I would say, if your planned exit is to a third party, then today's the day to start thinking about who should buy your business. Now, that doesn't mean you're going to go out and put the business for sale sign in the front yard. But what you want to do is think about, here's my product and here is somebody else's business, and can it fit in there? Is it a puzzle piece? Large corporations are forever making the decision, do I build it or do I buy it? And it's become increasingly challenging to build it myself. So they'd rather buy it. And the reason they want to buy it is there's, young entrepreneurs like yourself are innovating all the time. And large companies are all about creating scale and scope and leveraging up to the next level, but they're not as good at innovating. So they rely on innovators to bring them new ideas. Your ability to be attractive to a strategic buyer has a lot to do with your ability to envision how you will be attractive to them. You need to bring them the idea of why is this going to fit into this, and how is it going to help them? How, exactly. How is it going to help them? And do that thinking for them, quite frankly. I don't know about others on the phone, but strategic buyers are, sometimes they're very good visionaries, but most of the time they're like, hey, it's cheaper to buy these people than try and figure out how to do this on our own. And cheaper usually is time to market, not just dollars. So they don't have, they want to get it now type of thing. So if you can think through and build your product so it has a natural fit. Now, I would also caution you, don't try and fit it into one end game, make it adaptable, but thinking through how you make it attractive is something you can start doing right away.
Yeah, Tracey, I'll kind of elaborate on that. On our investment banking mandates, and I'm sure you ran into this too in investment banking, like you'll put a list of potential buyers together for a company, and in your heart, you'll say, this is the one, this is who's going to buy it. And it's almost never that person. It's, you'll always be surprised at who has an interest and why they have an interest in the company. And that's why you run a process. You reach out to a lot of different people, because You just don't know who has interest and why. So you want to look at why a company would buy you and develop business that's valuable to a lot of different people, not just one. That'll make your company healthier and more attractive long term, because you don't know. You put a lot of risk when you design for one, and so I think. But there's a lot of value in understanding why somebody would buy you. So design for the why, not the who, and I think you'll be better off long term.
Well said, Scott.
Very cool. Well, somehow we got to near the end of our time, and maybe we can squeeze in one more question if it's short. Does anyone else have any questions? Otherwise, we're going to wrap this up. Going once, going twice. Thank you, everyone. This was really great. Check out the chat. We have the CBIC Tech on Tap tonight, an annual meeting. Obviously, it's going to be virtual, which is what we have to do, but we hope to see you there. Thank you, everyone. Special thank you to Tracey, Claire, and Scott, and India. Thank you all. And see you next time, session 6.
Thanks, everyone.
Take care,
Bye.
everyone.
Thank you.
Thank you.
December.